the technical analysis considers the historical stock price movements. It leverages the patterns, trends, and also past charts to forecast the stock's future price movements. Technical analysis is backed by data. Therefore, it uses the historical price movements, trade volumes, and returns to forecast the stock prices. Moreover, technical analysts are of the assumption that all the fundamental aspects of the stock are already factored in, and they remain unchanged. Also, interferences from technical analysis give buy and sell signals. Such signals are also known as support and resistance levels. Furthermore, a technical analyst would see a buying opportunity if the stock price is nearing the support level, lower limit, since they predict that the prices after reaching the support level will shoot up. On the other hand, if the price of a stock reaches the upper price limit, then it indicates a fall from there on. Therefore, a technical analyst would sell the security. Also, predicting the support and resistance levels requires a lot of experience. Therefore, any wrong prediction may not honor the price range, and the stock price may continue to rise or fall beyond the point. As a result, one can experience significant losses. There are momentum indicators like RSI, MACD, moving averages, etc., that help in predicting the entry and also exit prices of a stock. Furthermore, a technical chart comprises candlesticks that help in analyzing the stock price movements. Also, the interpretation of a candlestick can vary from analyst to analyst. Therefore, technical analysis is highly subjective in nature. Moreover, technical analysis is for short-term trading, where you can predict the stock prices for the short term. Thus, investing based on technical analysis can be risky. Unlike fundamental analysts, technical analysts don't care whether a stock is undervalued or overvalued. In fact, the only thing that matters is the stock's past trading data, price and volume, and what information this data can provide about the future movement in security. Technical analysis is based on a few key assumptions. One needs to be aware of these assumptions to ensure the best results. 1. Markets discount everything. This assumption tells us that all known and unknown information in the public domain is reflected in the latest stock price. For example, there could be an insider buying the company's stock in large quantities in anticipation of a good quarterly earnings announcement. While he does this secretively, the price reacts to his actions, revealing to the technical analyst that this could be a good buy. 2. The how is more important than why. This is an extension of the first assumption. Going with the same example as discussed above, the technical analyst would not be interested in questioning why the insider bought the stock as long as he knows how the price reacted to the insider's action. 3. Price moves in trend. All major moves in the market are an outcome of a trend. The concept of trend is the foundation of technical analysis. Another way to look at it is that once the trend is established, the price moves in the trend direction. 4. History tends to repeat itself. In the technical analysis context, the price trend tends to repeat itself. This happens because the market participants consistently react to price movements remarkably similar way, every time the price moves in a certain direction. For example, in uptrending markets, market participants get greedy and want to buy irrespective of the high price. Likewise, in a downtrend, market participants want to sell irrespective of the low and unattractive prices. This human reaction ensures that the price of history repeats itself. By tracking the open, high, low, and close, we can summarize the price action. When the markets open for trading, the first price at which a trade executes is called the opening price. The high. This represents the highest price at which the market participants were willing to transact for the given day. The low. This represents the lowest level at which the market participants were willing to transact for the given day. The close price is the most important because it is the final price at which the market closed for a particular period of time. The close serves as an indicator of the intraday strength. If the close is higher than the open, then it is considered a positive day, otherwise negative. The closing price also shows the market sentiment and serves as a reference point for the next day's trading. For these reasons, the closing price is more important than the open, high or low prices. The open, high, low, and close prices are the main data points from the technical analysis perspective. Each of these prices has to be plotted on the chart and analyzed.